As of this moment, with the market live and in full session, Upstart Holdings, Inc., trading under the ticker UPST, is priced at $57.44. That represents an intraday gain of approximately 0.90%, a seemingly calm and positive day for the fintech disruptor. Many investors watching this ticker on their Fidelity mobile app or Robinhood platform might see this gentle upward drift and feel a sense of validation in the company's long-term story. But this surface-level tranquility masks a ferocious battle raging just beneath, a conflict that pits the popular narrative against a stark and increasingly aggressive institutional reality. While retail traders are buying the dip, a startling report from Jefferies has just revealed a massive surge in short interest, now standing at a colossal 27.7% of the float. This isn't just a minor increase, it's a definitive statement from a significant portion of the market that they are not just expecting a pullback, but are actively betting billions of dollars that Upstart is headed for a significant decline. This creates an immediate and powerful disconnect between expectation and reality. The expectation is that you're investing in the future of lending, an AI powerhouse destined to reshape finance. The reality is that you're stepping onto a battleground where some of the most sophisticated players in the market are wagering heavily against that very future. The common belief, the one that has propelled Upstart to its dizzying highs and supported it through its crushing lows, is centered on its core premise, that its artificial intelligence platform can underwrite risk more effectively than traditional credit scoring models like FICO. This narrative is incredibly compelling. It suggests a future where access to credit is democratized, where deserving individuals overlooked by outdated systems can secure loans at fair rates. For many engaged in online investing, particularly those who favor high-growth tech stories over stalwarts like Apple stock or dividend payers, Upstart represents a paradigm shift. It's a classic disruption play, and platforms like SoFi Invest make it incredibly accessible for anyone to take a position, believing they are getting in on the ground floor of a revolution. This belief is bolstered every time Upstart announces a new partnership with a regional bank or credit union, feeding the perception of inevitable coast-to-coast adoption. The expectation is a smooth, linear progression towards market dominance, a journey where its superior technology will simply win out over time, making it a cornerstone of any forward-looking investment portfolio. But the market is rarely that simple, and the reality of Upstart's current situation is a complex tapestry of macroeconomic headwinds, intense competitive pressure, and a growing chorus of skepticism from institutional players who have dug deeper than the headline promises. Let's challenge that common belief by examining the recent stock movement with a more critical lens. The post-earnings performance has been telling. Following its last report on August 5th, the stock didn't soar on promises of future growth. It plunged, entering a consolidation phase largely between the $60 and $70 range before settling where it is today. For active traders using an interactive brokers trading platform, this period has been defined by choppy price action and high volume, indicating significant institutional distribution, not accumulation. This brings us back to that staggering 27.7% short interest. This isn't just a handful of hedge funds, it's a substantial portion of the market essentially screaming that the company's valuation is detached from its fundamental prospects. These short sellers are not betting against the idea of AI and lending. They are betting that Upstart's specific model is vulnerable, particularly in the current economic climate. Their thesis is likely built on the fear that as interest rates remain elevated and economic uncertainty lingers, the very non-prime borrowers that Upstart specializes in identifying will be the first to default, proving its AI models to be less prescient than advertised during a benign credit cycle. The recent IPO of Klarna and the continued market presence of competitors like Affirm also add a layer of competitive reality that the simple disruptor narrative often ignores. Capital and market share are finite, and the fintech lending space is becoming increasingly crowded. This isn't a David versus Goliath story anymore. It's a battle of titans, and Upstart's recent stock performance reflects this brutal reality, a far cry from the effortless ascent many had expected. The daily swings are no longer just market noise, they are the tremors of this underlying institutional conflict. To fully grasp the stakes, it's essential to understand precisely what Upstart Holdings does. Unlike a traditional bank, Upstart does not lend its own money, for the most part. It operates as a technology partner for banks and credit unions. Its AI-driven platform analyzes thousands of data points far beyond a simple credit score to assess a borrower's true risk. When a loan is approved, it is originated by one of Upstart's partner institutions, and Upstart takes a fee for this service. This is a capital-light, high-margin business model in theory, and it's what initially attracted so much excitement. The business thrives on volume and the continued willingness of its partners to fund the loans its platform approves. In the past, this model fueled explosive growth. The stock went public in December 2020, and early investors saw astronomical returns as the stock became a market darling. However, its past performance has also been a lesson in extreme volatility. The stock has experienced epic crashes from its all-time highs, demonstrating its acute sensitivity to changes in the interest rate environment and the availability of capital in the financial markets. When its lending partners become risk-averse and tighten their credit boxes, or when the capital markets that buy these loans get nervous, Upstart's revenue stream is directly impacted. This is the structural vulnerability that the bullish narrative often overlooks, and the bears are laser-focused on. It's not just about the quality of the AI, it's about the health of the entire credit ecosystem, a factor largely outside of Upstart's control. For anyone considering self-investing in this name, understanding this business model is paramount. It's a high-octane vehicle, but one that is deeply dependent on the condition of the road it travels on. Looking toward the future, the outlook for Upstart is a fascinating duality of immense opportunity and existential risk, perfectly embodying the tension between expectation and reality. The primary risk, as highlighted by the massive short interest, is credit performance. If a recessionary environment leads to a wave of defaults that significantly exceed what its AI models predicted, the trust from its lending partners could evaporate overnight. This is the nightmare scenario. Furthermore, the company faces significant regulatory scrutiny. The Consumer Financial Protection Bureau is taking a very close look at AI-driven lending models to ensure they do not perpetuate hidden biases, and any adverse ruling could fundamentally challenge Upstart's operations. The reliance on a relatively small number of banking partners for a large portion of its revenue also presents a concentration risk that cannot be ignored. These are the realities that must be weighed against the glowing expectations. However, the catalysts for a potential turnaround are just as powerful. The most significant tailwind would be a dovish pivot from the Federal Reserve. A sustained decrease in interest rates would not only lower the cost of borrowing for consumers, driving up demand, but it would also make the loans Upstart originates more attractive to the institutional buyers in the secondary market, thus encouraging its partners to lend more freely. Expansion into new, larger markets such as auto loans and the mortgage industry represents a monumental opportunity to scale its revenue base. Each new partnership with a financial institution is a validation of its technology and a step towards wider adoption. The key is whether Upstart can successfully navigate the current economic turbulence to capitalize on these future growth levers. Comment below what you believe is the single biggest risk facing Upstart in the next 12 months. Is it rising credit defaults, increased competition, or the regulatory environment? For an investor, the path forward requires a clear-eyed assessment. A diversified approach, perhaps utilizing tools like Schwab Intelligent Portfolios or a basket of Fidelity ETFs, could balance the high-risk, high-reward nature of a stock like Upstart. For those directly trading the stock on platforms from Fidelity to Interactive Brokers, the coming months will be a test of nerve. In summary, the story of Upstart Holdings is a powerful lesson in looking beyond the obvious. The expectation sold to the market is that of a revolutionary tech company on an unstoppable march to redefine the multi-trillion-dollar lending industry. It's a narrative of pure innovation and growth. The reality, however, is far more complex and precarious.
The stock is currently a proxy war between a resilient base of growth investors and a formidable and growing army of short sellers. Its success is tethered not only to the brilliance of its code, but also to the unpredictable currents of the macroeconomy and the risk appetite of its financial partners. The calm green number you see on your screen today at $57.44 does not tell the whole story. The real story is in the institutional positioning, the credit market anxieties, and the fierce debate over whether Upstart's AI is a true all-weather revolution or a fair-weather phenomenon. Understanding this divergence between the popular narrative and the underlying reality is the key to making an informed decision, not just about Upstart, but about any investment in today's complex